Welcome back to the Japan FinTech Observer. Get ready for a quick hit of the latest news in Japanese finance and fintech. We're diving into the headlines, breaking down the trends, and leaving you with the insights you need to stay ahead of the curve. Let's go.
Picture the starting line of the Indy 500. You've got, sleek, aerodynamic race cars revving their engines. The crowd is deafening, the smell of burning rubber in the air. But right in the middle of the pack.
A famously cautious, sensible family sedan.
Right. An everyday family sedan. And the driver's looking over, revving the engine, looking like they are about to just leave everyone completely in the dust.
It's an image that fundamentally contradicts what you'd expect from that kind of vehicle.
Which is exactly why it's the perfect way to describe what is happening right now in the global financial world with Japanese banks. For years, decades really, these institutions have been the definition of slow, steady, and incredibly conservative.
Yeah, they were basically the family sedans of global finance.
Exactly. But suddenly, they're pulling up to the starting line and projecting massive, aggressive profit growth. They're completely rewriting their own playbooks. And the financial targets they're suddenly throwing out there are turning heads all over the world.
Oh, absolutely. The scope of the ambition we're seeing in the latest round of company data and financial research is, it's unprecedented for this sector.
So today, we are going deep into that stack of sources, detailing the new midterm plans across Japan's banking sector. The mission of this deep dive is to decode why these historically cautious financial institutions are suddenly projecting such staggering profit growth.
And, to understand what this transformation actually means for the global financial landscape.
Right. Because whether you're actively managing a portfolio for you listening, or you just love a really good, unexpected business turnaround story, we are going to get to the bottom of the mechanics driving this shift.
Okay, let's unpack this, because the raw numbers in these reports are genuinely surprising.
Yeah, they really are. When we look at the updated midterm plans, specifically projecting out to the fiscal year ending in March 2029, major and mid-tier Japanese banks are targeting 3-year net profit compound annual growth rates of roughly 8% to 25%. Wait, 8% to 25%. Let's linger on that for a second for you listening. A compound annual growth rate, or CAGR, means that steady year-over-year compounding growth. Hitting an 8% to 25% CAGR for a 3-year stretch is like the kind of trajectory you expect from an aggressive tech firm.
Definitely not a legacy bank.
Right. Now, anyone who follows global markets knows the Bank of Japan, the BOJ, has been stepping away from its historic negative interest rate policy.
Yeah, finally moving rates up.
Yeah. And the mechanics of banking dictate that when central banks raise rates, the spread between what a bank pays you for your deposits and what it charges for loans expands. Their profit margins naturally widen. So I have to push back a little on this narrative of a grand reinvention. Is this all just a rising tide lifting all boats?
You mean, are they just getting lucky with the macro environment?
Yeah. It feels a bit like a sailboat captain claiming they've engineered a vastly superior boat, when in reality, the wind just picked up.
Well, a lot of casual market observers are making that exact assumption. They see the Bank of Japan moving rates and assume the banks are just, coasting on that macroeconomic breeze.
But they aren't.
No, the company data tells a very different story. What's fascinating here is that these massive growth plans are actually based on highly conservative estimates regarding that wind in their sails.
Conservative meaning they aren't modeling for some massive spike in rates.
Exactly. Many of these banks are only assuming a policy rate of about 0.75% to 1.25% in their midterm plans. To put the mechanics of that in perspective, they're building these massive 8% to 25% profit growth targets, assuming only 0 to 2 additional rate hikes from the BOJ.
0 to 2. Oh, wow. So they aren't relying on a hurricane of interest rate hikes to push them forward at all.
Not at all. They are effectively saying to the market, even if the wind barely blows, we have built an engine that will win this race regardless.
Okay, so the interest rate tailwind is certainly helpful, but the math simply does not add up to a 25% growth rate if you only look at the central bank.
Right. The bulk of this projected profit growth requires looking under the hood at structural changes within the banks themselves.
And within the broader Japanese economy, I'd imagine.
Exactly.
Which means we need to look at what they are doing differently on a functional level. The research mentions an acceleration in corporate actions as a major driver of this new revenue.
Yeah, there's a broad-based demand for financial functions driving this.
When I hear corporate actions in the context of Japan, My mind immediately goes to the demographic situation.
Oh,
We are talking about an aging population of business owners. Are we looking at a massive wave of successions and buyouts?
you've hit on a major catalyst there. Japan has a vast ecosystem of mid-sized companies where the founders are hitting their 70s and 80s, and they desperately need an exit strategy.
And the banks are stepping in as the critical facilitators here.
Exactly.
And the mechanics of that must be incredibly lucrative for a bank because they aren't just lending money to these companies anymore.
Right? No, it's way beyond simple lending. If a retiring founder needs to merge with a competitor or sell to a younger firm, the bank acts as the advisor, earning a really hefty M&A advisory fee.
Oh, I see. And then they probably finance the debt for the acquiring company, generating loan interest.
Spot on. And finally, they step in to manage the newfound liquid wealth of that retiring founder.
That is wild. One demographic event triggers 3 distinct high-margin revenue streams for the bank.
And this is happening at scale across the country. Alongside this, the data points to the rapid proliferation of cashless payments.
Because Japan has historically been a very cash-heavy society.
Very much so. But as that transitions to digital payments, the banks are capturing merchant fees, transaction fees, and monetizing the resulting data streams in ways they simply couldn't when people were just handing over paper yen.
Right. That plays directly into a phrase in the research that set out as the core engine of this whole turnaround. The data highlights a long-term, irreversible trend, what economists call a secular societal shift from savings to investment.
It is the single most pivotal shift in the domestic market right now.
Think about what this means culturally for a moment, for you listening. For decades, the reality for Japanese households was parking money in zero-yield savings accounts.
Literally just stagnant capital.
Yeah. But inflation has returned to Japan, which means leaving money in a zero-yield account actually loses purchasing power. So you have an entire nation waking up and moving dormant capital out of the metaphorical mattress and into active asset management.
And if we connect this to the bigger picture, this societal shift forces banks to fundamentally change how they operate.
Moving away from traditional lending.
Exactly. When a customer moves their life savings from a basic deposit account into an investment trust, a mutual fund, or domestic stocks, the bank transforms from a mere custodian of cash into a wealth manager.
Ah, so they start earning management fees, advisory fees, and brokerage commissions.
Right. The revenue model shifts from traditional slow burn lending to dynamic fee-based asset management.
And because the very nature of how they make money is changing, they are being judged differently by the global markets. Because overseas investors are grading them heavily on return on equity, these banks are suddenly obsessed with how much profit they can squeeze out of every shareholder dollar.
Yeah, return on equity, or ROE, is the ultimate scorecard for corporate efficiency on the global stage. And historically, Japanese banks haven't scored particularly well here compared to their international peers.
What were their old targets like?
In previous midterm plans, the ROE targets were usually sitting in the 10% to 12% range for the massive megabanks, and a rather sluggish 6% to 8% for the major regional banks.
Which is safe and stable, but it's not the kind of efficiency that makes global institutional investors rush to buy your stock.
Exactly. But the new disclosures from this earnings season show a dramatic break from that past. The mega banks are now targeting over 12%, and several major regional banks are aiming for over 10%.
Wow. Let's look at the specific data for the giants, starting with MUFG.
So MUFG expects to achieve their current medium-term target of 12% ROE this fiscal year, but they are already positioning themselves to aim for mid-teens ROE in the medium to long term.
Mid-teens.
Yeah. And the research explicitly notes they are doing this by benchmarking against the ROE levels of top-tier U.S. bank competitors.
Okay, here's where it gets really interesting. Why do these domestic Japanese giants care so much about Wall Street peers? They already dominate Japan.
Because dominating their home turf just isn't enough anymore.
Think of global capital like a ruthless sports talent scout.
Mm-hmm.
That scout has billions of dollars to deploy, but they are only going to sign the athletes, or in this case, the banks that are hitting specific elite performance metrics.
Right, and the Japanese banks have realized that sustainable double-digit ROE is the only metric that Talent Scout cares about. It is the key to unlocking higher stock valuations from overseas investors.
If you want global capital to flow into your stock, you have to play the global game.
Exactly, which explains why the other megabanks are making similarly aggressive moves. SMFG drew a lot of attention from market participants when it announced a medium to long-term ROE target of 15%.
15%. To get a legacy bank to 15% efficiency requires a serious restructuring of where you put your resources.
Yeah, and SMFG is achieving this through a structural pivot they call a multi-franchise strategy.
Let's break down what that actually looks like in practice.
It means they are aggressively building and acquiring different financial businesses across various Asian markets. So consumer finance in one country, commercial banking in another, leasing operations in a third.
By creating this sprawling, diversified network of franchises, they aren't reliant on just the domestic lending margin.
No, they are funneling their capital into the highest growth potential areas, particularly expanding their global corporate and investment banking divisions.
They are hunting for yield wherever they can find it in the region. And Mizuho, the other major player in that top tier, is taking a slightly different messaging approach, right?
They are. They raised their medium-term target to over 12% by FY329, but their initiative is explicitly called Beyond PBR 2.0x.
Okay, this brings us to price-to-book ratio, or PBR. The book value is essentially the net asset value of the company. If you sold off all the bank's assets and paid off its liabilities, the book value is what's left.
Right. So Mizuho isn't just saying they want to be more efficient. They're publicly declaring they want the stock market to value them at more than double their literal liquidation value.
They are trying to command a massive premium based on their ability to generate future wealth.
And to achieve that, Mizuho is leveraging its incredibly stable domestic corporate business to fund aggressive growth in its wealth and asset management arms, moving higher up the value chain to improve those stock multiples.
Now, seeing the mega banks flex their muscles makes sense. I mean, they have the resources to compete globally. But the data in these sources reveals something even more surprising. The regional and mid-tier banks are making structural leaps that are arguably even more dramatic.
Yeah, which proves the trend isn't isolated to a few top-tier CEOs. The entire Japanese financial ecosystem is rewiring itself.
Let's look at the regional data, because it's highly revealing regarding how different banks use their specific advantages. Take Resona Holdings.
Right, Resona. They've set a medium-term ROE target of 12%, assuming a 1.0% policy rate.
A 12% target for a regional bank is already aggressive.
But they also provided a sensitivity analysis for a different scenario. They indicated that if the policy rate hits 1.5%, their ROE target shoots up to an incredible 14%.
A 14% ROE for a regional bank surpasses some of the mega banks' targets. This speaks to a specific mechanical advantage they have: sticky regional deposits.
The mechanics of sticky deposits are crucial here. Regional banks serve communities with deep local ties. Their customer base often consists of older demographics, local pensioners, and local businesses running payroll through them.
Customers who are incredibly loyal. They aren't constantly refreshing mobile banking apps to move their money to a competitor offering a 0.1% more in yield.
Exactly. So the deposits stay put, they stick. And when you have a vast pool of cheap, stable funding and the central bank raises interest rates even slightly, the margin you make on lending that money out just explodes.
It provides massive leverage without the bank having to do much extra work. Shizuoka Financial Group is another regional player, explicitly citing this dynamic, projecting a mid-teens ROE target for the year 2030.
While the regionals are leveraging their deposit bases, the most fascinating case study in portfolio reconstruction from the data is definitely Japan Post Bank.
Japan Post Bank, or JPB, the ultimate example of a legacy institution. It's the most traditional, ubiquitous financial institution in the country, the place where almost every citizen has a basic account.
Yeah, and yet their midterm numbers show them expecting their ROE to nearly double.
Double.
Yeah, they are sitting at 5.3% for FY326, and they are targeting 10% by FY329.
You do not double your return on equity in 3 years just by tweaking the margins.
No, they are executing a massive overhaul of how they invest the trillions of yen they hold. According to the midterm plan, a primary driver of this growth is generating an additional 800 billion yen simply by reconstructing their Japanese government bond, or JGB, portfolio.
Okay, let's explain how you squeeze 800 billion yen out of government bonds, because they are notoriously stagnant assets. A bond is essentially a loan to the government. For a long time, Japan Post Bank was effectively lending to the government at near 0% because of the BOJ's policies.
But now that the central bank is allowing yields to naturally rise, JPB isn't just passively holding those old, dead bonds until they mature. They are actively reconstructing the portfolio.
Right. They're selling off the old low-yield paper, managing the duration risk, and aggressively redeploying that capital into new bonds that actually pay a meaningful higher return.
And that active cycling of the portfolio is what generates that projected 800 billion yen.
But reconstructing domestic bonds only gets you so far. To double their ROE, they are stepping entirely outside their traditional comfort zone. They are projecting an additional 200 billion yen in profit by diving into riskier alternative assets.
Specifically, private equity and foreign bond investment trusts.
Japan Post Bank, taking civilian deposits and allocating them to private equity to boost efficiency, is like the perfect encapsulation of this entire sector-wide shift. They're moving out of the purely safe lane and stepping firmly on the gas.
This raises an important question regarding market valuation.
Oh.
Yeah, if these banks actually execute on these complex plans, if Japan Post Bank hits 10% ROE through private equity and bond cycling, if the mega banks hit 15% through multi-franchise expansion, how much untapped value is currently sitting in these historically undervalued stocks?
Right. The relationship between ROE and price-to-book multiples is the key to the financial opportunity here. The research outlines that currently, Japanese banks generating an ROE between 6% and 10% are trading at price-to-book multiples ranging from 0.6x to 1.5x.
At the lower end of that spectrum, a 0.6x multiple means the stock market is valuing the bank at less than the literal book value of its assets.
The market has heavily discounted them, treating them as dead money because of their historically low profitability.
Exactly. The market looks at them and says, even though your assets are worth $1, we are only going to pay 60 cents for your stock because you don't do anything efficient with that dollar.
But the data projection is clear. If these banks raise their ROE toward these new, aggressive, medium and long-term targets, it unlocks those significantly higher price-to-book multiples.
The global market will be forced to stop treating them like sluggish dinosaurs and start valuing them like highly efficient global financial engines.
It represents a complete repricing of the entire sector. They aren't just trying to earn more operational revenue. They are executing structural changes to fundamentally alter how the global capital markets perceive their intrinsic value.
Right.
So what does this all mean? We started out looking at what seemed like a straightforward cyclical story about a central bank finally raising interest rates. The easy assumption was that Japanese banks were just going to sit back and coast on that macroeconomic tailwind.
But the reality is much deeper. We are witnessing a profound structural transformation built on demographic shifts and changing consumer behavior.
These legacy banks are weaponizing a massive societal shift. They are taking an entire nation's transition from passive cash savings to active asset investment and using that momentum to aggressively restructure their portfolios.
They're getting into private equity, building Pan-Asian franchises, aggressively cycling bond portfolios,
And ruthlessly targeting global tier profitability metrics to attract foreign capital.
They recognize that remaining stagnant is no longer an option. They are transforming their massive balance sheets from passive storage units into active high-yield engines.
This deep dive really serves as a masterclass in how legacy institutions can completely reinvent themselves from the inside out. For you listening, it proves that massive growth opportunities don't just live in Silicon Valley tech startups or disruptive new industries.
No, sometimes the most explosive financial growth is hiding in plain sight.
Within sectors that everyone else has written off as boring or stagnant or just set in their ways.
The narrative of the slow, unmoving Japanese bank is officially outdated. The data proves they are actively shedding that reputation.
The everyday family sedan has swapped out its engine, and it is gunning for the finish line. Which leaves us with a final thought to mull over as we wrap up today's deep dive. If these historically cautious, heavily regulated banks can completely reinvent their profitability models, aiming for global top-tier metrics just by tapping into a domestic shift in how people handle their money,
What other boring legacy industries around the world are just one societal catalyst away from their own explosive renaissance?
it certainly makes you wonder who else might be quietly pulling up to the starting line, waiting for the right moment to hit the gas.